lot, but I hope to address some of the very, very important points that you as, some of you as founders and some of you on the other side of businesses as investors or bankers would be interested to know about the entire founder ecosystem and startups. The topic of the presentation really is minefields before milestones. I think before we understand what the minefields are, let's just go over. Oh, okay, it's working. Yeah, let's just go over the milestones. Journey of a startup or anyone getting into business, we actually see it in 4 stages. First one being the incorporation stage. This is the stage where, you formulated your idea, you're looking to launch your product. There is a certain degree of PMF that you've got, which is product market fit, and you are finally figuring out what kind of a corporate structure to be put in place. So the first stage really is incorporation. It's marked by, structuring of the entity. How are you going to hold the entity within India? Are you going to have companies which are holding it or infusing funds from outside India? You will also potentially be looking at founders inter se arrangement if there are more than one founders, and getting the right set of advisors on board. This is also the time where you will see a lot of cost constraint. You are basically not really funded at this point in time. The second stage is the early stage startups, which is where you see a lot of fundraising that happens at angel level, a Series A, or seed funding and things like that. This is the time where you're setting the bedrock for your company, the legal, contractual framework, etc. is being set up. You're figuring out what is your product and, whether it actually falls within the legal contours of the regulatory regime that you are subject to. This is also the time to think about your ESOP policy, meaning people who are coming on board with you as employees, you may not have enough funds to give them. So what is it that you offer? You may look to, giving them some sort of sweat equity and all. So this is, an early stage is marked by this. The third stage is basically the growth stage. This is where, your product, your business has done well. You have a lot of access to capital, your PE, VC funds, your bankers are lining up. They are okay to give you more and more funds. You now need to think about how to deploy that capital really. What is your philosophy of business? Are you looking at an organic way of growing and continue to grow in the same segment? Or are you looking to diversify your business? You want to, if you're in retail, your marketing, e-commerce, do you want to get into financial services? What are the kind of businesses which are going to aid your current business or the primary line of business? This is also the stage where, as a founder, you will get a lot of liquidity opportunity. What I mean by that, you will have the ability to basically sell off your stakes in your company, either dilute your positions or completely exit, sell it out to a strategic investor. So that's something that happens in a growth stage. And then you have the late stage of a company, which is basically you possibly become a giant. You are looking at a listing opportunity with the stock exchanges, or there is a potential big M&A on the horizon for you. Some of the examples for this would be for a late stage entity, any of these entities, a tech company who's managed to get a listing with any of the stock exchanges, Zomato, a Paytm, these could be now considered as late stage companies. But given the age group that we are in, maybe 5 years or 10 years ago, they were actually the startups. So this is the kind of trajectory that all of them have had. This is basically a nutshell about, what are the stages or what are the milestones that you are likely to hit as a business person. Now, what are the minefields? The way we look at minefields are basically can be bucketed into 3 sets. One is governance related issues, the second are compliance related issues, and the third are the issues which arise as a part of your fundraising activity or getting capital within your system. So, I'll just be quick about the governance and compliance related pointers. In early stage company, your focus or the issues that you may land up in will be relating to incorporation, getting the right structure in place, or, potentially also be dealing with founders disputes and, cost constraints and all. How to deal with that? The idea always is always surround yourself with the right set of advisors. How do you get them? Cost, of course, is a constraint, but one way to go about it is, having that ecosystem around you or interacting with people enough so that you get people on board who have the reputation and experience to hold your hand through it. If cost is a constraint, which it will definitely be, sweat equity or ESOP plans, etc. These are some of the things that really, really work out. One very important key takeaway for in this stage is that if you are more than one founder, then it's really, really important that you guys get your founders agreement in place. And the reason for that is we have seen in the startup ecosystem a lot of founder disputes emanating. Some of it is obviously because of difference of opinion about how to run the business, potential role of people in companies and all, but it could be as related as your co-founder's spouse moving to some other country and they don't really want to be in the country. Once your co-founder really moves out, the equity arrangement or the structure that you've really put in place, that's not going to work out. Why should they have the benefit of the equity when they are not really putting in any effort? So these are some of the situations that really arise. Right structure, again, is important. In the startup space, we always, until a few years back, there was always an issue around how to go about incorporating the structure. Do we need to have a holding company which is outside India? And the driving factor for most of the people in those situations used to be that it gives me the ability to raise funds, cheaper funds outside the country and potentially list the company outside. But then there were other constraints, and we saw that the founder ecosystem started doing their businesses and having the entire corporate structure in India. And the simple reason for that was India came across as a much more lucrative environment for listing companies and raising public funds. There are obviously a host of other reasons also that apply to that, but those are some of the considerations that any founder who's getting into that space needs to look out for. When you move into your early stage arrangement, over there would be 3-4 things again that need to be kept in mind. Your board structure. Because early stage is the time that sees, the first round of fundraising and all, the founder's control over the company often gets diluted. What that means is that you may be losing administrative control of your company. How much of that do you really want to do that? That's something that you need to keep in mind in this phase of your growth. After that, there would be things like role of a founder in the company, which pretty much remains quite substantial in this stage. But many times the investors would want to seek more and more engagement in the business and more say in the business. So those are some of the things which become minefields in a sense that they will constrain your ability to run the business in the manner that you really want to run it. Again, ESOP, the sweat equity grant is something that becomes really important over here as well. In your initial phase, if you got carried away and created a wide ESOP pool for a lot of your employees, it may not be long-sighted enough, because to get out of employee stock option, that itself is a very, very difficult task, because you can't really dissolve it or you can't really exchange or take back those options in exchange for cash. And that really becomes difficult. So even while giving or coming up with an ESOP scheme, the idea should be that you need to be a little more long-sighted when you're doing that. Bookkeeping related matters is something that needs to be kept in mind. Many startups we see, they don't really get into adopt the correct kind of accounting practices. Most of the time, the idea is that take the money, whatever that is coming to them in form of investments, just take it on, but not really follow the business in the right spirit and sense, following the procedures. Many times we see accounting standards also not being followed, and balance sheets, etc., are prepared just for the heck of it, for doing those regulatory submissions and all. While it's okay, nobody is really going to catch you in early stage, but it does become a problem when you get into a growth stage, when there is a potential private equity investor who's looking at your company because you've shown a very, very promising business to them. And then there is this thing called due diligence that happens, which is both financial and legal. And this is the time where most of your malpractices get caught. And one of the big setbacks or a minefield in that sense that a company hits in growth phase is when they have not followed accounting or legal practices properly. It has a straight down impact of valuation, your ability to negotiate the terms of funding, your potential dilutions and all of that. So, that becomes really, really challenging. These are some of the things that you need to keep in mind. The third phase is the growth phase. Over here, there's one thing that I would like to talk to you about, the kind of capital that you are getting. As founders, it's super important that you understand the basic difference between equity and debt, or some of the hybrid structures, in terms of what is your company's liability to the people who are basically funding you for or providing that capital to you. The other thing is that where is that money coming from? Is that something that is domestically raised, or is this something that's coming from outside the country? If your funding entity, investor, or your bankers, whoever's going to give you that capital are situated outside India, there is something called Foreign Exchange Management Act, which is something that needs to be really, really kept in mind. That's the core of your legal requirements for fundraisers. And then we really move on to the fourth stage, which is late stage, which is a position where your revenues have basically hit more than 10,000 crores. You are either listed, or you're potentially looking at a listing over a stock exchange, raising public funds, or you are looking at a big exit in form of a bigger M&A. In these stages, some of the legal challenges and complexities become even more complex, and the idea really is to surround yourself with specialist advisors and people who can really look after the requirements well, and who are people who are more aware and experienced than you are as the founder. So, this is in a nutshell compliance and governance related matters. I will just take you through some steps around fundraising, because that's something that hits the core of startup ecosystem, and some of the things that founders should keep in mind. One is assessing investment readiness of your company. That basically means that how well your company is on governance side of things, on compliance. Is the product that you've launched or the business that you're doing is really legally compliant or not? That assessment is something that needs to be done. Second part is putting in place good governance structures. Again, it relates to the first one. The better your governance is, the better chances of getting that fund and your deal not really falling through. Legal compliances, business license, reporting, IP protection, and startup registration. One of the things that I would like to mention, before you start any business, please do have it assessed whether it requires any kind of mandatory licensing. In a very, very summary fashion, I can tell you that financial services as a space is regulated. So you are potentially looking at a regulation from Reserve Bank of India, or the Security Exchange, or the insurance regulator. So please do have your product assessed. IP protection from both sides. You should not be violating someone else's IP, and ensure that you yourself are getting your own IP registered in form of trademark, brand name, whatever it is, because that really has the ability to hamper your business and the kind of liability that you will be subjecting yourself to. Finding the right set of investors, again, super important. There is, there would be a lot of news articles around the fact that how XYZ investor was really antagonizing a founder or a company. This is something, these are real world issues. So even if an investor fund or a bank does not really have that kind of reputation, it's essentially you who are dealing with the other side, with your relationship person. So you need to get people on board with whom you get along with in a manner that your ideals about running the business are same, so that things really work out for you. Domicile of investors, this is something that I spoke about. The Indian foreign exchange regime is highly regulated. Depending on the kind of capital you're getting, whether it is debt or equity, please have it assessed whether you are eligible to get that kind of money or not. The person who's providing that capital to you, whether they are eligible to provide that capital to you or not. And then the third aspect is, what are the terms of investment of those capital? For equity, there are pricing guidelines. Fair market value needs to be the floor or ceiling depending on whether money is coming in or you're investing outside. For debt, there are limited set of routes which are available. How much interest can be charged to you is something that's regulated. When can you actually repay the entire amount? How much amount can you repay? All of that is regulated. So please do look into it and have that basic knowledge around that regime. Sorry, how much time do I have? 5 minutes, or have exceeded? No. Valuation and dilution, this is something, it's one of the favorite topics for founders. Sometimes, in running the business, it really becomes the game of valuation. With every subsequent equity round, you're looking at a higher valuation and trying your best to get the best valuation that you can. Dilution also is a pain point for many founders, while of course everybody wants capital, but nobody wants to lose control. So what is the fine balance that you strike? That's a commercial call, but you need to be smart about it. How do you do that? There are 2-3 things that come out of that. One is that the kind of transfer restriction you're putting on yourself and on the incoming investors, whether in form of right of first refusal or right of first offer, tag, drag, these are all some of the technical terms. I'm not sure, I'm trying to not go too elementary on that, but if you have any questions, happy to take that after the session. That's important. Again, creation of ESOP pool, I keep harping on that because I understand for founders, the capital is an issue, and this is a very great way of ensuring that, you retain some good people as employees within your company. Creation of ESOP pool, this is slightly more structured. I think I can take it offline if anybody wants to discuss that. And then founders agreement is something that I would like to take people through. There are certain key things that need to be thought about whenever there are more than one founders in any business. One is that segregation of roles and responsibilities. If you are good with sales and marketing side of it, but there's someone else who's doing the tech stack for you, please have those roles and responsibilities very clearly identified. How much value each of the role brings to the table. Do your equity allocation accordingly. And of course, whatever capital that is being brought in by each, that is also going to be a determining factor for equity allocation. Vesting of shares. You can have certain kind of conditionalities attached to vesting of shares. That would basically mean that, if there are 3 people who are coming together to set up a business, they all need to achieve a certain kind of objective. They need to stay with the company for certain timelines. So these are some of the conditions that you can definitely look to impose on each other. Exit mechanism, again, very important. There may be a time where your co-founders want to leave. There could be a time you want to leave the company because it's not going in the direction that you wanted. So have an agreement in place to ensure that whatever things you can reasonably foresee or perceive, you're getting all of that done. Treatment of shares in case of exit of a founder. Let's say your co-founder wants to leave. What do you do with the equity that you have allotted to them? One of the ways to deal with that situation is that to the extent they're leaving before an agreed time period or before making their own contribution, you can have a reversal of those shares. Again, the law of the land really prescribes certain conditions in terms of how you can have those shares extinguished or bought back by the company. So keep track of those laws in terms of how it can be done. But contractually, you can put that obligation on each other that, hey, if you leave before the business being set up or whatever timeline or milestones you agree, then your shares vesting will be reversed. Introduction of a new founder, your technical partner leaves, you want to get someone else, your agreement should provide for that. This also becomes very, very basic. I think next part is non-compete. This is again super important. 3 of you ideated a business, 2 of you are continuing, and the third person wants to do that same business, but separately, or they think that they can do it better. The value for that idea is something in that situation gone. You are unnecessarily creating competition for yourself. So ensure that there is a non-compete. Non-compete itself comes in various forms and manners. One of that is around, you can have a time-bound non-compete. Say for 3 years, you're not going to compete or do a similar kind of business. Or it could be a geographical area. In India, you will not do this business. So those are some of the things to think about. Confidentiality, of course, your business idea needs to be kept confidential. Of course, the product will go out in the market, but how exactly do you do that? What is your source code? What is your tech stack? All of that is something, or what is the kind of data that is being deployed? All of that should be a subject matter of confidentiality. Ensure that your agreement provides for it. Intellectual property to vest with the company. Again, don't keep it in your own name or in your co-founder's name. A company is a separate legal entity, so ensure that it remains with the company. This will ensure that, it has a longer life. It has certain kind of perpetuity. Even if you're not there, your co-founder is not there, the company can carry on with that business. Dispute resolution, again, important. Ensure that you have the most efficient and the most cost-effective form of dispute resolution. We as lawyers, we always ask for arbitration to be put in because it's more legally binding than a mediation, which is just an informal process. And it's more cost effective compared to you going to the court of law and trying to cost effective and also time efficient if you compared to you going to the court of law. So those are some of the basic things that we would always advise founders to keep in mind. I do have a longer presentation, but I don't believe we have the time. So, happy to take any questions if anybody has. Yes, ma'am, please.
Thanks for that very detailed and technically simplified. If a firm gets acquired and a new firm doesn't really do the type of task, suppose I'm heading consultancy.
Right.
And the acquiring firm has only administration, tax compliance, or HR related. So my core competency is not something the new firm is doing it, though it's bigger and all.
Yeah.
What happens to me as an employee? Like, okay, what is my future?
It will actually depend on the terms of acquisition, right? In your case, assuming that your firm is a smaller firm and the other
True.
entity that you're talking about, you technically get subsumed within that. And if you become one company, in most cases, you have been acquired because they see value with you. So your core competence in terms of your employees and the expert professionals which are there in your firm will come on the roles of the other company, and you'll possibly continue to do that segment, right? But let's say your company was not doing well and it's some sort of a loss-making arrangement, and the owners of your company have really decided to leverage whatever value that they can derive, then they will sell off the company, and the acquiring company, then you're essentially at their mercy in terms of what they really want to do to you. So it's possible in that situation that you may be asked to leave or move on.
So employees benefits, social security, nothing
Whatever are the accrued benefits, ma'am, which is until the date when you've been asked to leave, that's something that will come to you. Yeah.
Thank you.